But first, we thought we'd start the day off after Rachel with a beginner's guide to opportunity zone investing, or opportunity zone investing 101. So now I'd like to bring in my co-founder and partner at OZ Pros, Ashley Tison. At OZ Pros, one of the things we specialize in is educating people about opportunity zones and how to execute opportunity zone strategies. So Ashley, hello, how are you doing today?
Excellent, Jimmy. Thanks for having me. And what a great event! It's fantastic to see all of the folks that are presenting their pitches, and looking forward to hearing those and to seeing the questions and feedback we get on those today.
So I do have, by the way, one thing before you get going. Ashley and I were chatting before the event about what his presentation was going to look like, and Ashley, you asked me, hey, should I get into the IRS forms? And I said no. But I've got a question here from Luis right off the bat that says, hey, what's the process with the IRS to reinvest capital gains in an opportunity zone? Which forms need to be filled out? So please do go into detail on 8949 and 8997. All right. give Luis the answer to that question.
So
you work your way through.
You told me not to geek out, and I get to strap my geek hat on and wear it proud on my tax geek stuff. So excited about that. Hopefully, so I'm going to try to not get into the weeds too much, but keep it high level, but at least give you the information that everybody's going to need in order to be able to have a working knowledge about how to do this. And then once again, we're always available to follow up with questions and that kind of thing to help people understand it fully. If you're trying to self-do this, one of the nice things about investing in a third-party fund is that they're going to walk you through a lot of the questions about this. And so they're going to handle most of the forms that I'm talking about, or they're going to give you the information that you're going to need for the forms. So first, what is a qualified opportunity zone and where are they? Now, this is a little bit redundant for, I'm assuming, pretty much everybody on this call, but I still want to hit it because I think that it's relevant. There are 8,700 of them across the United States. And like Rachel and Jimmy both said, this was bipartisan legislation. And once again, this was originally put together by the Democrats. And if you look at the base of the program, it's really designed to do exactly that. It's designed to help the communities that need it the most. And so I think that I don't care what party you are, I think that everyone can agree that helping people that need help is a good thing, and that allocating resources of federal government dollars along with private investment resources is a really desirable outcome, regardless of what politics what your politics are or what party you're in. And so I think that this program, through the legislation, and I got to hand it to them, through 3 pages of legislation that was buried into a huge act, they were able to successfully accomplish what I would argue that no other kind of federal program had done. Is that number one, it got private institutional capital's attention. Number 2, it got private institutional capital off the sidelines. And then number 3, it got private institutional capital interested in staying around and sticking around for the long term in the form of patient money, right? And the way that they did that was through 3 benefits of the program. So they aligned the legislation with ultimate benefits in order to accomplish those results. So the first, like I said, right, and this is what is there to get it off of the sidelines, was this temporary deferral. So what they were trying to do was they were trying to take money, capital gains money, out of the stock market and to put it to work in these areas that needed the most. And so if you invest into a qualified opportunity fund, you get to defer those taxes until December 31st, 2026. And you need to invest within 180 days. And I'll work through it in a second here. It's either 180 days from when you got the gain, that's if you sold it individually, or 180 days from the partnership or S-Corp tax filing deadline if you got the gain through one of those vehicles. So in so doing, they basically said, listen, we want people to look where they have capital gains and then use those capital gains to pull them into these areas that need it the most. The second thing that they did in order to get capital off the sidelines was they offered this step up in basis. So if you are invested for a 5-year or a 7-year hold by December 31st, 2026, then if it was 7 years, which basically you back up 7 years from December 31st, 2026, which made it December 31st, 2019, which unfortunately has passed, you get a 15% step up in basis. Now the next deadline is December 31st of 2021. And so if you're in by 12/31 of 21, you get this 10% step up in basis, which is effectively a 10% reduction in your taxes when you go to pay those in April of 2027. But the third and final benefit, which is probably the most significant, is that if you hold your investment at the qualified opportunity fund level, you get a step up in basis to fair market value, which not only eliminates capital gains, but it also eliminates depreciation recapture, which becomes really powerful on an after-tax side-by-side investment analysis. Because almost all of the funds that you're going to hear today, I'm pretty sure that all of them will have some kind of depreciation component that they're going to be able to take inside of their fund. And in taking that depreciation, what they're effectively able to do is to offset income against that depreciation and pass to you as an investor effectively a tax-free dividend. And so normally what happens when you do that is that when you go to sell that asset, you recapture all of that income that happened, because the IRS is like, okay, if you're going to get it into capital gains, you can't have your cake and eat it too and get the depreciation right off as well. But in the opportunity zone play, because of that step up in basis to fair market value after 10 years, it basically makes it so that there aren't any taxes paid, because your basis is equal to the price that you're paying for it. So that on an after-tax basis becomes really powerful. And I see a bunch of stuff happening in the chat. And Jimmy, I'm not going to be able to monitor those questions, but if you can, and if you see something that pops up that is directly on point, just interrupt me and I'll go into further detail. Okay.
I got it, Ashley. Yeah, I gotcha. Actually, I did just get one question here from Charles. He asks, so wait, new money into an OZ fund will run beyond 12/31/26 for purposes of tax deferral / step up?
So it's a really interesting phenomenon, because effectively what happens inside of the legislation is that it turns out after December 31st, 2026, they cleaned it up in the final regs to say that if you're invested, that you're grandfathered in on the zones and that the zones are complete. And so I think that as an investor, you can reasonably rely upon the fact that if you get your money into a deal, that effectively you pay your capital gains on the original investment in 2027. So it's December 31st, 2026 is when they become due. But then you then have to hold your investment for equivalent of 10 years, which by very definition would be past 2026 on every single investment that got made. And so in order to deliver the benefit of the program, they have to have the eligibility past December 31st, 2026. So I think that everybody can reasonably rely upon the fact that that's going to happen. And this step up in basis is good, not only past 10 years, but up until 12/31 of 47. So you have to sell by 12/31/47 in order to get this step up in basis to fair market value. So, it's not specifically delineated in the regulations, but I think that by writing the regulations the way that they did, is that we can basically rely on that the opportunity zones as set are set until December 31st of 2047. Now, I think that they might end up introducing some additional legislation to kind of clean up that loophole, which is what I think everybody's hoping that they do. I also think that, that we may see them do an extension on that 12/31/26 deadline because of COVID and because of some other things. What I'd really like to see is for that to happen after December 31st of 2021, and then basically go back and move everything out 2 years. So that way, if you were invested by 2021, you get the benefit of the 15% step up, but then it gives an extra 2 years to get the 10% step up, and then it would effectively make all the taxes due in 2028. If I were a lawmaker, that's what I would be doing, and that's what I would be a proponent of. And I think that we would see more capital come into the mix as a result. I'm also going to talk about my magic wand in here in a second as well, about how I wish that they would extend it to non-capital gains money too, so that way we could see a massive influx of capital into the opportunity zones. So this is a side-by-side deal, right, on $1 million investment. And this basically assumes that your $1 million investment doubles in value over the course of 10 years. And so what happens is that, if you're paying taxes, you're not going into an opportunity zone, you effectively have an opportunity cost of the money that you get to invest over here. So this $238,000 in taxes that you have to pay becomes a negative interest loan from the government to you until December 31st, 2026. Because not only are you not paying interest on it, but they're effectively paying you interest by giving you a 10% reduction by putting it into an opportunity zone deal. So then if you're in by 2021, you get the 10% reduction in cap gains taxes, which would be $23,800 in this case. So you'd be paying $214,000 instead of the $238,000. And then this is the real kicker, is that when you go to pay this taxes, right, after you sell, right, you're going to net 1.16 million on a traditional investment, and you're going to net $1.785 million on the opportunity zone investment, which is around 54% higher. And that's just assuming that you double your money. This also doesn't account for dividends off of it or anything else. This is just if you put your money in and then it grows. So with the depreciation and no depreciation recapture, it can go continually higher relative to the percentage difference. So opportunity zones become a very attractive differentiator between a regular deal and a deal that works, right, versus a deal that works in the opportunity zone. So this is basically opportunity zones on a page, right? And it's a lot of information that's kind of packed, and unfortunately, you got to kind of make it small when you do that. But this is basically how opportunity zones work. And once again, we're keeping this high level, but like I said before, you got to start with a capital gain, and that capital gain has to go into a qualified opportunity fund, and it's within 180 days. That's if you get it individually. But that capital gain, and this is also important, I get questions about this all the time, is what about, I know that I generated capital gain from the sale of real estate, but what about from the sale of a business? Absolutely. Sale of stock? Absolutely. The sale of appreciated gold? Absolutely. Any minerals, that kind of thing. Swapping, like futures contracts that you're selling that have appreciated in value that generates a capital gain, whether that's long-term or short-term, that's going to be eligible to invest into a qualified opportunity fund. What will not be eligible is stuff that might walk and talk like a capital gain, but that's actually depreciation recapture. So on the back end, we take care of depreciation recapture after a 10-year hold. Unfortunately, we can't take that depreciation recapture on the front end and put it into it and get the benefit of the deferral on it. So, Jimmy, I think that might have been one of the questions that you had. Did you have something else?
No, I think we're good. Let me turn my video here so you can see me too. I did get a couple of people asking, what happens if the tax rate in 2026 goes up? That's a big concern with investors. And I've heard some anecdotes of investors actually pulling out of deals because they see that Biden is elected and they just kind of sense that tax rates are going up. So I'd like you to address that.
So let's talk about that. So the first thing is that if you're worried about tax rates going up, you ought to absolutely be going into an opportunity zone deal because it is the quintessential mitigator on capital gains taxes. After a 10-year hold, it eliminates them. So you pay a little bit of taxes now. It's kind of like life insurance. If you pay the taxes now and you buy the life insurance with after-tax dollars, you get to take the benefit of them tax-free. It's the same way here. You buy into your QOF interest with basically capital gains dollars that you're going to push off the capital gains until December 31st, 2026. Yeah, you're going to pay taxes then. But the key is that the growth of the new investment is going to come back to you without any capital gains. I also want to talk about like if you look at history and you look at kind of the up and down and ebb and flow of capital gains, when there has been an effort to increase it substantially, typically that effort has usually only lasted around 2 years. And I don't know all of the whys on that. And once again, that's a big kind of general analysis, but 2026 is a long way off. And I don't necessarily know that Biden winning this election has a whole lot of input on what taxes are going to be in 2026. That's more going to be driven by what happens in the midterms in 2022, and then also what happens in the next presidential election, and then the following midterms after that. So, I mean, we've got a long time until that time period of when you're actually going to pay the capital gains taxes. So a lot can happen then. And so once again, it goes into the question of, would you rather invest those tax dollars now and then figure out what you're going to do with them in 2026? The other component of this, and I'm going to show that you're either going to pay taxes on your original gain or what the value of your new investment is. And so there's a lot of creative things that you can do inside of that, including potentially gifting some of your new investment into a donor advised fund in 2026 in order to knock those taxes down, or allocating other investments in 2026 into high depreciation type things that are going to offset those capital gains. So there's lots of flexibility that we have between now and then in order to be able to accommodate potential tax increases.
Hey, one other point I'd like to make, Ashley, is that at the end of the day, this also becomes a net present value or time value of money equation, right? I mean, essentially, you're getting an interest-free loan from the federal government on that deferral period for, what is it, about 6 years right now. And
Correct.
so there is some value there. So even if the tax rate does increase and you do end up paying at a higher rate on your 2026 recognition in 2027, you still might be better off just because of, I mean, it depends on the discount rate you use, but get out your MPV calculator and run that equation and you get the idea.
Tax-free compound interest is the eighth wonder of the world. Yep. And if you can take money that you would normally be paying in taxes now and stick that into a vehicle that's giving you tax-free compound interest, why would you not do that? It's basically the equivalent of being able to take your money that you would be paying in taxes and sticking it into a Roth IRA. It might be a little bit riskier, but if, you know, with the operators that we got on this panel, you know, and on this show today, all of those deals are good deals. And so you're going to have growth in there, and you're going to have tax-free growth. And so why would you not take your money, put it in there now, and then let's figure out what we're going to do to mitigate taxes in 2026. The key is that you get to take that cash and invest it now and get it working for you. So the way that you do that from the mechanics standpoint is by dumping it into a QOF. And like I said before, that's within 180 days, or that's within 180 days from the partnership tax filing deadline if you got the gain through a partnership or an S corporation. Now, what is a qualified opportunity fund? It's actually going to be really simple. It's basically any partnership or corporation that's organized for investing in qualified opportunity zone property, right? And so that QOF can either then invest directly into qualified opportunity zone business property, or it can invest into another qualified opportunity zone business, which once again is a partnership or corporation that's organized for purposes of investing into opportunity zone property. Now, one of the reasons why we do that, and why I'd say that probably the lion's share of the funds that are going to be on here today have this double stack structure, is that because when you invest into a QOZB, instead of a 90% requirement of opportunity zone property at the fund level, the QOZB now has a 70% requirement instead of the 90%. So it gives us a lot of flexibility to be able to do other stuff in addition to just opportunity zone stuff. And it gives us a little bit of wiggle room in case there's a footfall. It also gives us a 6-month cure period for if for whatever reason we blow something at the QOZB level, we've got 6 months to cure before we start incurring penalties at the QOF level. And that can be really important. So for unforeseen circumstances or something gets jacked up or whatever, it gives you some reasonable amount to cure. Now, what kind of business can you do as a qualified opportunity zone business? pretty much limitless. The one limitation, well, there's two limitations on this from a testing standpoint, but is this 50% of your business must come from an active conduct of a trade or business in the opportunity zone. And that comes from a three-part test. And I'll get into that three-part test later on. But effectively, it's how are you paying your employees? Are 50% of your employees getting paid in the opportunity zone, or 50% of your hours worked getting done in an opportunity zone? And if you can effectively hit that requirement, which basically means that you're kind of location agnostic, you could qualify as an opportunity zone business. The second one is that you cannot have more than 5% non-qualified financial property. And non-qualified financial property is cash, stocks, bonds, that kind of thing. So what you can't do is set up like a publicly traded stock holding company inside the opportunity zone and make a gazillion dollars trading in the market and get that tax free. Because what the goal is for us to have people coming into the zones and for us to have money that's flowing through the zones. And that then accomplishes the objective of the legislation. Now at the QOZBP, so that's Qualified Opportunity Zone Business Property level, that's effectively the stuff that the Opportunity Zone business has to buy. It's got to be tangible property used in a trade or business, and that can be real estate, and it can be either owned or leased. If it's leased, you can actually lease it from a related party. If you buy it, it has to be bought from an unrelated party after December 31st, 2017. And then the original use of that property or has to be in the zone, or it has to be substantially improved. Substantially improved basically means that you double the basis of the value of the building. Now for a business, that's a little bit different. So if there's a business that's already in the zone, so they've already got property and stuff like that that's inside of the opportunity zone, what we're then going to do is we're going to turn to this 70-30 asset test instead. And so you've effectively got this 70-30 good asset store or bad asset store that's up here. And anything that's already in the zone, because you're not going to get new use of that because it's already been depreciated in the zone, that's the test, it's going to go into this bad category. So existing assets will go into your bad 30% category. And then what you'd have to do is you just have to get enough good assets in your 70%. So that's either new property or stuff that was outside of the zone that you're moving into the zone. That's going to go into your good category. So that's literally opportunity zones on a page. Now, I'm going to get into some of the more specific rules about this, right? About like how the taxes become payable and some of the deadlines.
Ashley, before you move into that, we had several people asking for that slide. Well, is it okay if we make that slide available? Because it was hard to read. It's very small. It was very compact.
Come on. What do you mean? That's hard to read?
Oh, come on. I think if you're on a phone, I think some people might be watching on their phone. I want to make sure, are we going to make this slide available? Is that
absolutely?
All right? Okay, so,
absolutely.
So
yes.
for everybody asking, if you can't read it, or if you want to, look at this in more detail at a later date, we'll make this available. I'm going to send an email to everybody who registered for the event with a lot of the slide decks, and we'll be sure that at least this slide from this presentation gets made available. You'll receive it via email in the next couple of days here. And then Ashley, just checking on the time here. I know you've got a lot more to cover, but we can kind of wrap things up here in the next 5 minutes or so, because we've got a lot of questions that I want to get through. So if you have to gloss over a lot of stuff, just get to some high level points.
Perfect.
And then we'll get
I kind of did that with the slides. So what I'm going to do now is I'm going to hit this on this specifics, and then I'll get into the 89-49 for the investors. So the deadline is 12/31/2021 to get that 10% step up in basis. So that's the next meaningful deadline that's coming up. Then the taxes become due on December 31st of 2026, which makes this payable in 2027. And then December 31st of 2047 is the end of the step up in basis to fair market value.
Actually, I did have one person pointing out in the Q&A here that he believes that you would have to start paying those taxes by January 15, 2027 through the installment payments. What's your take on that?
Yeah, yes. Well, Yeah, I think that you have to, that's everybody's individual specific stuff about how they pay and how they do estimated quarterlies and that kind of thing.
But
So
some investors, depending on your tax situation, you might have to do quarterlies beginning in January of that year. But the larger point still is valid, that you're
so
deferring any payments until 2027.
So I'm a tax geek, but I'm not that much of a tax geek. So I'd love to talk to whoever brought that up and go down through the nuances of that. But here's the point of this slide. When you go to pay the taxes that become due on December 31st of 2026, you're going to pay either on your original gain or the value of your QOF investment, whichever is less. So if your QOF investment went down, right, you're going to pay taxes on the value of that QO investment as of December 31st, 2026. So for stuff that has a significant amount of depreciation that's going to drop the value of that, you're going to pay taxes on that new amount as opposed to what your original gain was. And so it should give people comfort as well that I'm not going to have a phantom income, right, on if like during that opportunity cost window, right, I invest my money and it goes down for some reason, I'm going to pay taxes on the lower amount as opposed to what my original gain was. And so then you can also use some creative stuff in the side of that depreciation deal in order to drop that value as of December 31st, 2026. This is how an investor is going to report their gain. Is that effectively, if they've got a gain from this and the numbers on this are a little bit different, right? It doesn't show the exact where these numbers go. But assuming that your basis was like $1, then you're gonna, or a million and $1, and you made $1,000,001, then you're gonna post $1 million here, and then you're gonna post a negative $1 million here about how you made the investment into a qualified opportunity fund. And so that's basically all you have to do in order to get it going, is to put that information on your 8949, and that negative number with the QOF name and EIN will indicate to the IRS that you're investing into an opportunity fund. This is the second form that an investor will file, is the 8997. And then you're going to indicate here what you've done relative to the investment that you've made into a qualified opportunity fund. Once again, the EIN, the date that it was acquired, the description of the interest that you got. So if you got 10% of the fund, then you're going to put that there in that blank. And then you're going to indicate whether it was short-term gain and how much, or long-term gain and how much that you deferred by investing into the fund. And then you're going to pick this up for the year end as well right there. And that's how you're going to indicate to the IRS that that you're investing into an opportunity fund. So Jimmy, I know we got some questions that are coming off of that, but that's the extent of the forms that have to be filed. And I guess it's a good stopping point because my PowerPoint froze. I'm gonna stop sharing, and then we can go into some of the Q&A. And then if I find a slide in here that actually will come back to life, then we'll go into that a little bit more.
Yeah, no, that's great, Ashley. I think we've got like 6 or 7 minutes for some questions here that we'll get to. So Thomas asks a really important question that we actually should have touched on earlier. He asks, this year, did the 180-day time frame to invest change? So there was some coronavirus relief that the IRS issued over the spring.
Correct.
I think it was back in June was their most recent guidance there. Ashley, can you get into that and
yeah, so
break that down?
Great question. IRA, so it was RevProc 2020-39, and it effectively made any deadline that occurred between April 1st and or December 31st extended automatically out to December 31st. So if you sold stock anytime between October 1st of 2019 all the way till now, you have the ability to be able to roll it over into a fund before December 31st and have that qualify. Similarly, if you had a gain through a partnership or an S Corp during 2019, you would effectively have until December 31st as well. If you've got monthly short-term gains, that clock is going to start 180 days from the actual receipt of the cash coming in on the gain.
And I just posted a link to an article where I break this all down and have a lot of the deadlines laid out there. You can find that link in the chat pane right there. Did you have anything else to say on that, Ashley, or should we move on to the next question?
Let's move on to the next question.
Okay, let's see. Are there any tax incentives associated with investing before the end of 2020?
Other than getting the deferral, nope. So just get it in. And, I mean, there's going to be I think that there's going to be a lot of people coming in before the end of the year. And then I think that accordingly, there's going to be a lot of QOFs that are going to be hunting for deals to put that capital to work by June 30th of next year as well. But no, there's not any tax incentive.
Yeah, well, the one big incentive, and I used this in my promotional language when I was trying to get people to sign up for pitch day, is a lot of investors are likely facing a year-end deadline this year because of that coronavirus relief extension that Ashley just discussed. If you had a 180-day period that was going to end, I forget the exact dates now, but essentially, I think the majority of the people who are attending this, who recognized a capital gain toward the end of last year or beginning of this year, their deadline is going to be December 31, 2020. Check with your investment advisor, check with your CPA, but in all likelihood, you have a year-end deadline this year if you fall into one of those buckets. A question here, another one from Luis. Luis is shooting.
And that clock starts. The clock starts 180 days from the receipt of the money if it's individual. Right. Yep. And the only distinction is individual versus inside of a partnership or an S corp. If it's a partnership or an S corp, that starts 180 days from the partnership tax filing deadline if the partnership or the S corp didn't elect to roll it over themselves. And so if you want to start before that deadline, you need to actually have the partnership or the S corp decline to make the rollover investment and offer that to you as an investor.
Yep. Well stated. And I do have all these dates broken down on that link that I just sent. I'm going to send one more link here too to a podcast episode I did that breaks down the dates even further. As I was saying, Luis is shooting to be MVP here. We got a couple more minutes left, but he's got a couple other good questions that I want to get to. He asks, how long does the Qualified Opportunity Fund have to use the capital?
Yeah, so the fund then actually, I'm glad that he asked that question because I got a slide for exactly that. And a lot of it depends on when the Opportunity Fund was organized, but for pretty much all of the ones that are on the call, and I'm just going to share my screen, not in presentation mode. So just bear with me on that one. But basically, you've got two asset testing deadlines. You've got the end of the year, and then you've got June 30th. For any cash that comes in during the previous 6 months that's still held in cash as of the testing deadline, you get to disregard that money. And so effectively what it does is for any cash that comes in between July and December, it makes June 30th the next testing deadline. And similarly, any cash that comes in between January and June 30th makes December 31st the next testing deadline. So you basically have, depending on when it came in, so if it came in on January 1st, you've effectively got a year. If it comes in on June 29th, you've effectively got 6 months. But you've got whatever the balance of that 6 month is till the deadline, and then another 6 months to deploy it into Opportunity Zone property.
Awesome. Ready for the next one here?
Yeah, let's do it. Let's rock and roll.
We'll go over a few minutes here because we've got a break built in, and then we're gonna have our first fund pitch of the day from Michael Episcope at Origin Investments, beginning at the top of the hour in about 10 minutes. So we'll get to do a couple more questions here, then we'll take a short break and we'll get back with Michael. Steve asks, if a software firm locates its sole office in an opportunity zone and the investment is held for 10 plus years, would the capital gain be tax-free?
Yeah, so a lot of that's going to depend on what he does for purposes of like how his employees work, right? Because you got a QOZB's got to hit 5 tests, right? And so the sole office would probably pick up the 70%. He's got to make sure that he's not licensing it out exclusively, right? And usually in a software business, you hit this test, but that would be another one to pay attention to, the 40% intangible property test. But the big one is going to be this 50% gross income. And that is determined by effectively 4 tests: that 50% of your comp must be paid inside of the zone, or 50% of the hours worked have to be inside of the zone. And the really tricky part about that is how you get your employees to effectively acknowledge that they're working inside of the zone. And this is employees and 1099 contractors. So if you're using coders that are working outside of the zone, you're going to have to count those against your bad 50% test. And so you got to make sure that you got at least 50% in the zone. So if you're highly paying yourself and that's in the zone, then that's fine. The other piece is that if you've got like coders and that kind of thing, you need to figure out how you're going to get that audit trail right done so that you can keep track of where they're working. And the best practice of that would be a timekeeping app that's got a geolocation piece to it. Great question. A lot more detail to that. And but those are basically the ones that you really got to be concerned about.
All right, Ashley, let's tackle 2 more questions and then we'll get you out of here. All right. And thanks for joining us today. Curious, Ryan asks this question. Now, he says he's curious about how this tax structure would be more favorable than a 1031 exchange. That's a common question that we get from investors. Hey, what's the difference between this and a 1031? Why is this better than a 1031?
So 1031 is tax deferral. This is effectively tax elimination, right? This is tax. You're removing the taxes on the back end of the 10% or the 10-year hold. And so the difference is that this one is location specific, whereas 1031, you can pretty much put it anywhere. But 1031 has to be in real estate. This can be in anything. And so it gives you way more flexibility about what you can invest in. And typically, real estate with an operating business or an operating business is going to have more of a higher return than would be available if you were just doing a 1031. The other thing is that 1031s typically, especially if you're doing it as part of an investment group. So I used to do TIC transactions, and you can't develop as a TIC. So they can't be engaged in a trade or business, whereas this is specifically the opposite way, where you have to be engaged in a trade or business. So, once again, it kind of depends on what your place is and what your stance is, but 1031 is basically just deferring it. And where you got to be really concerned about the 1031, and this goes into where this could get really interesting as it relates to the Tax Cut and Jobs Act sunsetting, is that it's scheduled to go away in 2026, right? It expires. And when that happens, that $22 million lifetime exemption drops back down to pre-Tax Cut and Jobs Act amounts. And it's unclear as to whether that's 2 million or 5 million. More than likely, it's probably going to be $2 million per individual, but you're talking about effectively a $4 million exemption, and then you're getting hit with estate taxes. So if you're in a 1031, what the value of it is at the time of your death, that's going to be what you pay estate taxes on. If you're in an opportunity zone, your next of kin are going to step into your shoes, and whatever the basis is that you invested into the deal, that's what's going to count towards your lifetime exemption that you're going to pay estate taxes on, as opposed to what the value of it is at that point in time. And so it can be a really also aggressive. Opportunity zones are a great differentiator for purposes of estate planning as well. So just something to think about in the difference between 1031 and opportunity zones.
Awesome. Thanks, Ashley. One more question I'm going to hit you with, and then we'll get out of here for a quick break.
Sure.
After holding the investment for 10 years, what about state taxes? Are they based on where you reside at the time or based on where the investments are located? So this is a nexus question, first of all, and I think it's also a conformity question. So maybe you can tackle both of those.
So nexus is going to depend a lot on whether it's real estate and how the taxes are paid based upon the state that it is where the investment's located. And the nuances of that are too complicated to hit. But when you go to pay taxes on it, that's going to be based on conformity. And so there's only 4 states that don't conform to the federal law. That's California, Mississippi, I think it's Massachusetts, either Massachusetts or Connecticut, and North Carolina.
It's Massachusetts. Yeah. So California, Mississippi, Massachusetts, and North Carolina are the 4 states that are not yet conforming. By the way, 2 years ago, when we first started this, there was a whole big laundry list of states that weren't conforming to the federal benefit. And now almost all of them are, just have 4 more to go. So especially if you have some nexus in California, you might want to be aware of the fact that the top tax bracket in California, I believe, is above 13%. So you'll be facing a bit of a headwind there, just something to keep an eye out on.
Correct.
Ashley, I got one more question here I want to address from Angela. She asks, is there a minimum investment required? And does it make sense to invest without having capital gains to invest? So I'll take this one. One, it doesn't make sense to invest without having capital gains to invest. You don't get the tax benefit from that. Although I should say, if it's a good deal and you believe in it, you can still invest in a qualified opportunity fund without capital gains. You just won't get the tax incentives, the tax benefits. And then the minimum investment amounts vary from fund to fund. We'll be hearing from 12 different funds throughout the course of the day today, and they all have different investment minimums. Oftentimes, I see funds starting typically in the $10,000 to $25,000 range, and then some of them have investment sizes, minimum investment sizes as high as $100,000 or even $500,000, and some of them have $1 million minimum investment. So there's a pretty wide range there. Ashley, any more parting thoughts? Otherwise, I'll get you out of here, and we'll take a quick 2-minute break before we get to Michael.
I think that you got to focus on the gain as it relates to making your analysis of whether it makes sense or not. And and once again, probably in order to justify the headache and the different stuff that you're going to have to do, unless it's part of like a much bigger kind of capital gain that you're dispersing out over a course of years or whatever, that you're probably going to want to have at least the investment minimums that are that people have inside of this call, in order to justify just the additional red tape that you're going to have to hit. But if you're anticipating hitting a home run on something, that completely changes the dynamic, especially on a startup, because a startup, you get all of that appreciation over 10 years coming to you tax-free. And so, Jimmy, I really appreciate you having me on the show today. Appreciate the time to be able to interact with everybody on that was asking questions, great questions, and be happy to answer and to follow on those. You go to www.ozpros.com and you can schedule a call with me on there. And appreciate the time again, Jimmy, and look forward to seeing the pitches.
Awesome. Thank you, Ashley. We are going to take a quick 2-minute break, and we'll be right back on with Michael. So thanks, everyone.